Welcome to our weekly episodes on WAKILI A Quick One series, where as a firm we intend to give our insights as answers to your possible legal problems and also develop legal opinions for you to anything that you might be facing or any challenge that you might be facing in matters law. Remember, you can always reach us through our contacts that will be shared on your screens at the end of this particular episode. You can always raise it as a legal question or a legal problem, and then we'll endeavor to do a very detailed legal opinion for you to guide you on how to undertake the issues that might be facing you at that particular time. Today we have a total of 5 questions that are going to be answered through this series. That's WAKILI A Quick One. Personally, I'm going to handle commercial issues, and my colleagues, Mr. Mbetera Clarence and Madam Shabola Rita, will handle the other areas. And then subsequently, Mr. Makonji Ronald will handle matters pertaining constitutional rights. So I wish to delve into my area that assigned to me this morning. The first question concerns the discretion by the banks to increase or alter the interest rates. Maybe I need to give a background on this. Most of the times we have found ourselves in a scenario whereby upon taking a loan from the bank or the microfinances, premised on several reasons. One of them could be the change in the inflation rate, and sometimes the change in your creditworthiness in terms of your ability to pay the loan, and the way you are rated. That's the credit rate of the borrower. The banks proceed then to increase the interest rate beyond the rate at which you took the bank loan at. And out of this, we have seen a lot of litigations arising between the borrowers and the banks themselves. So one, I do want to give my insights on this particular topic under 2 limbs. One is on the discretion of the banks or the lenders to increase the interest rates. Secondly, then I'll talk about what is called the induplam rule and what it entails and how it protects the borrowers from the lenders in terms of the interest rates and in terms of the total interest charged. To begin with, every time a borrower goes to the bank to borrow money, upon making request for that particular loan and the requisite processes taking place, you shall get into an agreement. This is contained in the loan offer, which you ought to go through as a diligent borrower and then sign an acceptance through a letter of acceptance before this particular amount of money in terms of the loan is given to you. The standard forms or the standard offers I've come across personally and that have also come to us in terms of the disputes that we are handling, you realize that it has a clause whereby the bank says it maintains the whims and discretion to alter the interest rates from time to time. And this has been the bone of contention. So that now there is then a binding agreement or contract between the borrower and the bank. So does that then mean that the bank has this blank check to alter the interest rates to attend to any rate whenever it feels like or whenever the conditions compel it to do so? I think I'll answer that first. That if the same is provided in law by section 44 of the Banking Act, if you look at the same section, in a bid to try and protect the borrowers who have the shorter end of the stick in a commercial transaction or who are most disadvantaged in a commercial transaction, this particular section provided that the lender, that is the bank, ought to seek permission from the minister. So that you want to borrow money from a particular bank within the market. Of course, what you signed in the agreement is that you have given it the power, authority, and the discretion to alter the interest rates. Ordinarily, that could be then be presumed to be a binding contract between the parties. That could therefore mean that each party in that particular loan contract has its rights and obligations and duties to benefit from and also to fulfill. Remember, the cardinal principle or the rule of the thumb is that the courts would rarely want to interfere with an agreement or a contract that is voluntarily entered by the parties. So remember, you've walked to the bank, you have entered into an agreement voluntarily, You have allowed the bank to have the whims and the discretion to alter the interest rates, and this is done to your disadvantage subsequently. So do you have a recourse? So that's why I was saying Section 44 was actually enacted to protect you from such kind of a scenario. What Section 44 then says is that for that bank to alter that interest rate, to increase that interest rate, even if you gave it the power through that loan agreement that you entered into and that you signed, it has to seek the permission of the minister. And in our case, normally they usually seek the permission of the central bank. So it is not discretionary, it's not a blank check in nature, notwithstanding the fact that you signed that agreement. To buttress my argument, there is a case most recently determined. That's the Supreme Court petition number E005 of 2023. That's the case between Stanbic Bank Limited and Sun Towers Limited, where the court actually insisted and actually gave it its decision on the fact that although there exists a contract, a free contract between the parties, that the banks are still bound by Section 44 of the Banking Act. That could mean that even when you are given that discretion by the borrower, you still need the permission of the ministers provided by Section 44 to alter that interest rate. So any interest rate charged against you beyond the interest rate that you agreed at the time of borrowing the amount is illegal and actually is recoverable by filing a suit in a court of law. I want to give a very brief comment also on that. That what we need to understand is that a loan contract is just like a normal contract between the parties. And amongst the most important ingredients that are provided in the offer for that loan is the interest rate. So that if you walked to a bank, I can use maybe Equity for instance, and found out how much interest rate at which they offer their loan, that interest rate will form a basis upon which you will choose which bank to take a loan from. So a mutation of the interest rate substantially changes that contract, mutates that contract, and that's why there is that protection before the court. Having handled that as my first limb, I'll proceed to the second bit called the in duplum rule. In duplum rule is also contained in Section 44, particularly Section 44A of the Banking Act. To put it as simple as possible for all of us to understand, is that it limits the total amount of interest recoverable for non-performing loans to equal the amount of principal at the time of non-performance. I want to clarify that. You take a loan of 3 million from a bank, so you are charged a particular interest rate, let's say 15% per annum. You pay that loan to a particular period for a particular period of time, and then the loan stops being performing. So maybe you've paid 1 million and you have a balance of 2 million. So the non-performing principal is 2 million. So the bank is only allowed to recover an interest from you to a total of 2 million, equal to the amount outstanding at the time the loan became non-performing. This is materially important because I've seen where some financial institutions have misinterpreted this to mean that then you can recover interest equal to the total amount borrowed, meaning the total amount that you took from the bank being the principal. That's not the case. It's the balance that was outstanding at the time that the loan became non-performing. There is an issue under this topic. I'll first give the decision of the court, then I'll render my opinion as an advocate, then probably we can have a debate on this. There is an tidy issue on this subject matter that I find a little bit itchy as to whether this in duplum rule applies to non-banking institutions. Non-banking institutions, I mean non-deposit taking institutions. There are two arguments. One, I'll give the argument that sprouted from the decision of the court. That's in the case of Momentum Credit versus Teresia Kabuia. That's civil appeal number 35 of 2022 by the late Justice Majanja. In his wisdom, Justice Majanja said that the non-deposit taking institutions are not amenable to this particular rule, and that could capture mostly the Shylocks, the microfinances. So in this case, he said they're not amenable to that particular provision, and therefore their interest can surpass the outstanding principal amount at the time of non-performance. That is the decision of the court. There is also another argument from another quarter about conscionability. That's the philosophy I belong to. We feel that the court failed to appreciate the spirit of Section 44. And there are so many cases that have sprouted after the Majanja case, and you can see the court leaning towards this argument of the conscionability of the interest rate and therefore the spirit of Section 44. This particular quarter, to where I belong to, actually believe that the spirit of Section 44 was meant to govern not only banks but all financial institutions. And in essence, it was meant to make sure that there's conscionability and protection of the vulnerable borrowers at the time of entering into loan contracts with the lenders. Thank you for having me today. I'll let my colleagues take over in their questions. I'll come back to address other issues in the afternoon. Thank you.